Hi, hello, namaste, Hatti. So, if you are an NRI living in the USA and holding mutual funds, for you. Most NRIs invest in SIPs before moving to the US or green card, they continue holding these funds. Passive foreign investment companies. So, of my three-part PIFIC Master Series, I intend to cover what is PIFIC, why mutual funds automatically become PIFIC, why these rules apply to H1B, L1, green card, and citizens, why PIFIC taxation feels harsh, and how US worldwide income principle changes everything. So, we will be learning all these 5 things in this part 1 that we are going to talk about today. So, before you redeem your Indian mutual funds, I very strongly urge that you understand these rules. Later in part 2, we will cover section 1291 default taxation, some real tax examples of some of my real clients as case studies I would like to present. Then in part 3, we will cover FBAR versus FATCA versus PIFIC, what to do if you never filed, what are the planning strategies, and what is this mark to market election. So in case you want to book a one-on-one iPlan consultation with me, my Calendly link is given in the description. You can always schedule an appointment at your convenience, and also alternatively you can write to asknanda@iletax.com with your questions. Yeah, so plan first, act later, and save taxes legally. So let's get into chapter 1. Have a paper and pen handy, and if you would like to have your friend or uh, colleague or your spouse along, please have them also. Now, welcome foremost to part 1 of our PIFIC Master Series. So as I said, if you are an NRI in the USA holding Indian mutual funds, what I'm going to explain today can save you from massive tax shock later. So this is not about panic, this is about awareness before action. Most NRIs discover PIFIC rules only after they read funds, and by then it is too late. So today we are going to understand the foundation of this. Now, the big problem that the NRIs face. Let me describe a very common story. You invested in SIPs in India before moving to USA. You never sold them. You never received dividends. You assumed nothing is reportable. And then suddenly someone like our agent, from my team tells them that you have PIFIC problem. That moment creates fear. But first, we must understand whether you actually have a problem and why. And why? Because the US tax system does not think like the Indian tax system. Things are different, and it is extremely important that you understand how these things work. Now let's understand who must comply with these PIFIC rules. Who these rules apply to. PIFIC rules apply based on tax residency, not visa category. I repeat, PIFIC rules apply based on tax residency and not visa category. So if you are a US citizen, a green card holder, A H1 visa holder meeting substantial presence test, like somebody who has stayed in the US for at least 183 days, or someone on L1 or any other OPT visa, if you have been in USA for more than 5 years, you are taxed on your worldwide income. That means your Indian salary, your Indian rental income, your Indian bank interest, your Indian mutual fund gains all fall under the US taxation. US is one of the very few countries that taxes worldwide income of residents. Of course, you may be thinking, but Nanda, I'm paying tax in India also. Yes, we will have a way to claim foreign tax credit. So when we are preparing your tax return, and in case you have already paid taxes on this income in India, there is a way how we can claim the foreign tax credit either on the US tax return or claim the double taxation avoidance agreement benefits on your Indian tax return. Okay. Now, we were talking about substantial presence test and all. Now, there are some technical calculations for that. But the simple way to understand about substantial presence test is like if you are at least 31 days in the current year and at least 183 days, based on a weighted average formula, for the last 2 years, then you're considered as a resident. Okay. Now, to cut the long story short, if you're somebody on H1, L1, or any non-immigrant visa, if you have been in US for at least 183 days, technically you are treated as a US resident. And then you will have to file form 1040. If you have more questions on your residential status, you have our contact numbers displayed below. You can always write to us or call our office. Now, what is this PIFIC? PIFIC stands for Passive Foreign Investment Company. As you see the slide here, it stands for Passive Foreign Investment Company. Now, listen carefully. PIFIC is not about fraud, neither is about illegal investment also. It is simply a classification. Again, passive foreign investment company, simply a classification. There are two tests here: income test and then asset test. Now, let's read it right from here. Income test: 75% or more of gross income comes from passive sources, then the income test is satisfied. At least 50% or more of the assets are held for production of passive income, then asset test is satisfied. Now, as you see here, PIFIC stands for Passive Foreign Investment Company. It's a classification the IRS uses to identify foreign corporations that primarily generate passive income or hold passive assets. Understanding this definition is crucial because it determines whether the tax rules apply to your investments. A foreign corporation qualifies as a PIFIC if it meets either of these two tests during the tax year. Most foreign mutual funds, including Indian mutual funds, easily meet this criteria and therefore fall under the PIFIC rules. That's what PIFIC means. Now, the question arises, why Indian mutual funds? Why do the Indian mutual funds, become PIFICs? Like, what does mutual fund do? It's a question to you. What does mutual fund do? Yes, right. It earns dividends, it earns interest, it gets you capital gains. So, all this is passive income. So, almost every foreign mutual fund automatically qualifies for this. Now, in India, mutual funds are perfectly normal, but in US system, they are foreign corporations earning passive income. That is enough to trigger PIFIC. See, it doesn't matter whether it is equity fund, debt fund, hybrid fund, growth fund, dividend fund. All usually qualify. All. So the same fund that gave you 12% CAGR in India becomes tax complexity in USA. So that is what I call the geographic paradox. Now, in India, normal long-term, capital gains tax. You hold it, for more than 3 years or something like that. 12 months in some cases. Simple, clean. It becomes, long-term capital gain tax. But in USA, the PIFIC regime applies. The interest charge, high marginal rates, same investment, different country, completely different treatment. Okay, so let this thing sink in your mind. Now, why PIFIC rules feel harsh? If you Google, PIFIC harsh tax in the Google, or you put it in the YouTube, I'm sure you will get many other articles also. But people don't want to talk more on these lines because clients, they kind of feel uncomfortable. Now people ask, why is US being so harsh? Because PIFIC rules were not written for NRIs. They were written in 1986 to stop wealthy Americans from using offshore corporations to defer tax. You are in US, so US encourages you to invest in US mutual funds, not in some foreign mutual funds, and they want to discard and discourage this practice. Congress wanted to prevent tax deferral, income conversion, offshore abuse when they wrote this law in 1986. Unfortunately, Indian mutual funds got caught inside that net. So, you are collateral damage of anti deferral legislation. Now, uh, in part 2, probably, we will go deep into section 1291. For today, I just want you to leave, with this thought, on this harsh default rule and all. In part 2, we will go deep into section 1291 when we talk about the harsh default taxation rule. That is where gains get allocated across years, high marginal tax rate applies, and interest gets added, and sometimes tax crosses even 50% also. And there's no capital gains benefit, as you see. So in the next video, probably, I'll show you actual math, and you will understand, why planning before selling is very, very critical. Go through all the slides that is mentioned here, and I will take you by this example probably, when we get into our next session tomorrow. Now, let me end, part 1 with this. Indian mutual funds are not illegal. Indian mutual funds are not illegal. But ignoring PIFIC rules is definitely expensive. This is not about fear, this is about understanding before action. In part 2, we will calculate real tax impact, and we will discuss FBAR, FATCA, what to do if we never file, and the planning strategies also. And if you are planning to redeem Indian mutual funds, do not act before watching all the 3 parts of this series. And if you want personal guidance, book a iPlan consultation with me. The description link is given in the YouTube description. So plan first, act later, and start planning regularly, then start just filing annually. That's very, very important. Yeah, so tomorrow we will build chapter 2, the harsh default rule, with the real tax examples of 2 of our clients, and that episode, I'm sure it'll be explosive. Yeah, see you soon in the next iPlan Tax Talks. If you like this video, please do share it with at least 3 of your friends, and I'm sure they will also be benefited from this. Yeah, take care, and I'll see you soon in the next video. Bye bye.